professional investment podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Scared Communications. Each episode, we welcome a guest to the show to share their news story of the week. And I'm delighted to welcome Gareth Mee, CIO of Legal & General's Institutional Retirement Division. Welcome to the show, Gareth.
Thanks, Charlotte. Great to be on the show.
Yeah, your title is a bit of a mouthful, and that's only half of it, your job title. Do tell us, what is your news story of the week?
Well, as I had posted about on LinkedIn, there hasn't been much going on in the news over the last week or so. So it was difficult to find something, but I settled in the end on LCP's forecast that there's going to be up to £550 billion worth of pension risk transfer business over the next 10 years. And that was published last week. They've been running it now for a very, very long time. And I think it's one of those surveys that everybody looks at when they're thinking about how to take the market, whether it's growing or shrinking.
Yes, I mean, the next question I have for you is, what was it that caught your eye about that news story of the week? But it's kind of obvious, isn't it? It's great to have that kind of helicopter view of what's going in the buy-in and buy-out market.
It is, and I think it's also useful when you've been able to see how it's grown through time. So I've been involved in the pension risk transfer market now for 19 years, and so we've seen the rise of new entrants. We've seen the growth of this business that I'm involved in now, and as you say, it provides this really good helicopter view of the market. And I think the report describes the confluence of a number of different factors at the moment. So you see pension schemes being in a much better funding position than they have been historically. You see insurance companies, lots and lots of competition going on in the market, and also market conditions being such that transactions can take place. So they were very bullish about the market, as are we.
Yeah, the last time I looked at this survey, which I think was actually a few years ago, I think they were forecasting around 50 billion a year to flow into the insurance sector annually. So 55 rather than 50 over each year for a decade is obviously a 10% increase. That would indicate there are some new market entrants coming to the market. As somebody who's very much in the thick of it, could you give us an indication of how the marketplace is developing?
Yeah, sure. So, I mean, if you go back nearly 20 years now, then you saw the last wave of really new entrants. So you saw these newcomers, Pension Insurance Corporation, Rothsay, you also saw Paternoster, Lucida. So you saw some real innovation in the market. And then, to be honest, over the last 10 years, it has been a little bit more boring. But where we are now, we see Utmost entering the market. We see Brookfield's first go at entering the market with Bluemont, and Royal London entering the market relatively recently. We should mention M&G. So Prudential, like us, were involved in the market a long time ago before some of these new entrants, but they've come back into the market now in a much more significant way. You've also now seen some US private equity companies come and think that this is a great place to invest. So you've seen Brookfield enter the market again, this time through acquiring Just, and you've seen Apollo entering the market through acquiring Pension Insurance Corporation. And I think that's really interesting as a testament to the market, to the investment opportunities, and the ability to provide pension schemes with what is still the gold standard. And so in terms of what we're doing, our own take of that is that we also think that it's important to bring new opportunities to the market. And so we announced earlier on this year a tie-up with Blackstone. They're not buying us. What they're doing is they're originating opportunities for us to be more competitive in the market. And so this is our take on a new twist on our business, even though we've been in the market for decades.
Yeah, it's very interesting when the private equity firms spot an opportunity and start to enter. Do you have any concerns about that? Because in certain areas of the market, they don't always have the best reputation in terms of maybe being too obsessed by driving out their exit price and loading companies with debt. Have you thought about how you avoid that? And not everybody has taken that route, because there's a story recently about Phoenix Group looking to sort of raise shareholder capital from shareholders as well.
Yeah, so I didn't mention Phoenix, but yeah, they're looking at a slightly different take in that they're looking for additional capital to come and support their business. We're keen to carry on deploying our capital in writing this important business for us. So I think you raised some interesting points. So the first thing to say is that our partnership with Blackstone is different. They're looking to create investment opportunities for us, which is something I'm sure we'll talk about later on in the podcast. We think that it's important to be able to have a wide origination platform, and so Blackstone help us to do that. And then in terms of Apollo's and Brookfield's approaches, the thing is the UK insurance sector is highly regulated, and I've got a meeting with the regulator later on this week. I think that they will be keeping their eyes on the UK insurance companies. We also have the financial services compensation scheme for those pension schemes that make it all the way through to buyout. So I think their business models will be different to ours, but I think that some of the sorts of horror stories that you were just alluding to there, Charles, I'd be very surprised if that was where we found ourselves in the UK insurance market.
Okay, well, that's good to know, reassuring for everybody involved and for the scheme members themselves. Now, the other thing that we haven't mentioned yet is there's been a lot of debate over the last year about the possibility of run-own versus buyout. Some people more cynical than others, looking at it as a way for investment consultants to keep their livelihood going. How realistic is it? Is it a real debate that we're seeing for certain companies? Is it a big movement or is it a small movement? Can you give us once again, as you're in the thick of it, how much of that is really going on and how much of it is just a talking shop?
I can't believe that anybody is so cynical as to suggest that this might be consultants feathering their own nest. As a former consultant for a long time, then that accusation must be unfounded. I mean, being serious, I think it's great that schemes have got a number of different options available to them. So the great thing is that now many more schemes are in a position to be able to make choices than they were previously. So actually in the LCP paper, they talked about only 5% of schemes in 2021 being able to access buyouts. They now talk about that being 45% today and 80% in 5 years' time. So it's great news that a number of schemes are now in a position where buyout is a real possibility for them. But you're right, buyout is not the only possibility. And for some schemes, then they do have the ability to run on. And historically, that has been a place where only the very largest schemes have really been able to focus. And of course, there's the rise of super funds as well, which might provide an opportunity for schemes that sit somewhere in the middle. I think the reality is that what we've seen over the last couple of decades is that where schemes have got the opportunity to access buyout, that being the gold standard for them, it's something that the vast majority will aspire to and still look to do. So I think it's fantastic that schemes have got more optionality. But as the LCP report suggests, and certainly our research suggests, it isn't going to dampen enthusiasm for buy-ins and buyouts in the medium term.
And you don't see that sort of appetite for run-on maybe affecting different bits of the market? I mean, is it more likely that smaller schemes are just going to carry on to buyout and larger schemes might opt for run-on? Or is it about the sort of the paternalism of the organisation, or even the depth of the DB trauma, as I like to call it, amongst the finance director and his staff and her staff even?
So I do think it's a really interesting question. I mean, it's interesting you should start with the small schemes. I think for small schemes, then buyout is a relatively easy decision. For larger schemes, it depends on the company, doesn't it? And for some companies where they believe that they want to be running what is ultimately a large financial services company alongside their core business, then and there's reasons that they may wish to do so, then I think that may make sense. But I think if you look at our pipeline for next year and for others, there's a record number of very large schemes that we're currently quoting on, and that has been the trend over the last few years. And so I would say that actually enthusiasm remains high even amongst the very large schemes.
Thank you so much for that kind of snapshot. It's really good to hear from somebody who's actually involved in it rather than maybe advising people. Really value that. But we are the Professional Investment Podcast, so we like to get down and dirty in investment in this podcast. Let's talk about all that money that's flowing into insurers. We've had a sort of a 10% kick up from the estimated 50 billion a year to 55 billion a year. That's a lot of money, a lot of zeros. It's all got to go somewhere. Where is it going to get invested, Gareth?
So that's my job and my team's job, and similar teams exist in other insurance companies. So if we go back to when I started my career, so 25 years ago, this was pretty boring. Insurance companies generally invested in government bonds to back these sorts of liabilities. That was sufficient. They would take the coupons on the government bonds, invest some in cash, and that would be enough. And then, as in the early days of my career, then those government bonds started to be replaced by corporate bonds as insurance companies sought higher returns in their portfolios. So that was all fine until the financial crisis. And the financial crisis had found that we needed a new sort of company to replace the banks. So banks previously were the lenders. They were the lenders to the private markets in particular. And so what we have seen over the last 15 years or so is we've seen insurance companies get much better at underwriting, harder to price, harder to value, harder to assess assets. And so we've become much more focused on private markets and private credit in particular. So your typical investment portfolio over the last 15 years has grown to be, let's call it 50% private assets and 50% public assets, where the 50% public assets have really been corporate bonds and the 50% private assets have been a wide range of different asset types. So equity release mortgages have been a mainstay of UK insurance companies for a number of years. They're very long duration. They play well to our ability to predict and forecast longevity. Commercial real estate loans have also been a mainstay of insurance companies, particularly with banks pulling back post-financial crisis, and also infrastructure loans. And then we have moved more into the world of private credit over the last 15 years, so more into the world of small and medium-sized enterprises and corporate loans. And so what does that mean today? Well, there's two things that have changed in today's market. So the first thing is on the public side, then corporate credit is at pretty much historical tights. You can go back in time and find some periods which are as tight as they are today, but you have to go back a very long time, and the economic environment was very different to where it is now. And so what we really see on the public side is that we see much more value in sovereign assets than we do in corporate assets. But then we talked a little bit about private equity companies coming into the market a couple of questions ago, and really a big part of what we need to do today is to be investing half of that £55 billion a year into private assets. And so that means that we've all got to try to have an edge over each other to be able to find the best, most attractive private assets to be investing in. And so for us, that is a mixture of our own capability and those of our partners, including most recently adding Blackstone.
Is there a concern that because you are a pretty constrained investor in that basically it's just fixed income, baby, in one form or another in terms of insurers, is there a concern that if we've got all of this cash flowing in year by year, that even, say, sovereigns or global credit or even private markets, which DC funds are also being encouraged to invest in, and I know there's been some criticism recently of private credit, that you're kind of all going to end up chasing the same asset and pushing prices out of beyond value and creating bubbles? Is that something that you think about as somebody who's managing such a large balance sheet?
So there's a few different bits to your question. So I think there's lots that's talked about in terms of bubbles in private credit. Lots of people are really thinking about the sub-investment grade market when they're thinking about private credit, whereas insurance companies, particularly here in Europe, are largely investment grade credit investors. And so it's a slightly different sort of credit market that we participate in. But you're quite right. If it's such a small subset of the market and we're all chasing the same assets, then we will inevitably start to push prices up. Fortunately, what we've also been doing concurrently is we have been becoming more innovative over time to try to widen the investable universe. So the regulations have helped a little bit, but basically since the inception of what us insurance professionals look at in terms of the regulations, which is a regulation called Solvency II, we've all become much better at understanding what assets are suitable for matching our liabilities. And so we've been working with third parties and our in-house teams to create cash flows which are more certain. So there's a number of different ways that we can do that. So we can do that in-house. So if you take something like affordable housing, we set up and built our own affordable housing platform, and we do our own internal structuring to make sure that we can access some of those different assets that other insurers can't access. We also work with third parties, so there has been developing an entire industry around structuring so that we can become investors in assets that otherwise we would find difficult to invest in. And the sort of thing I'd love to see more of is parties such as Homes England or the National Wealth Fund working even more closely with us to try to create more fixed cash flows. And so in the insurance world, it's partly about creating more fixed cash flows, so cash flows which are somewhat volatile, but taking some of that out. And in some cases, it's about turning cash flows from sub-investment grade, where insurance companies typically are not the best investors, into investment grade.
And I mean, what about, as you've sort of touched on UK productive finance, and we can return to that in a minute, but what about expanding broader? What about moving towards emerging market debt, or even frontier markets? And also thinking about the sustainability commitments that you have. Because I think something that was written about in Moral Money recently, it's insurers are right at the heart of the financial sustainability conundrum, because a lot of your business is insuring general insurance for flood, hurricanes, fire, protection insurance. So you've got to get the risks on that bit right. But on the opposite side of the balance sheet, you've also got to invest in the right assets that are going to pay out if you have to pay a liability. So if you get the risks wrong on either side of the balance sheet, that can be really catastrophic for an insurance company, which is, I think, the combination of the nature of the business that you do makes you probably at the forefront assessing climate change risk. And that's reinforced by the fact that you then have to make sure the assets are in the right place, because there's no point in you investing in a company that happens to be flood to play out on somebody's flood insurance, if I could take that example. So how are you thinking about how you invest sustainability sort of beyond sort of fixed income for infrastructure? If we think about things like natural capital, because there are a lot of interesting things out there that don't necessarily sit within quite a constrained fixed income universe. What's the innovation that's happening around that?
Fantastic questions, and there's loads of different dimensions to what you've just described. So the first thing to say is that we seek to be very progressive when it comes to the overall sustainability of our portfolio. So we have got, like many others, we have got net zero targets, which we are absolutely committed to. We're also, as a house, very focused on stewardship. So where the wider Legal & General firm has got votes where it is investing in equities, we take that role really, really seriously. So there's the bit about making sure that within the assets that we choose to invest in, we are progressive, sustainable, we've got minimum standards. There's then the point which I think is more interesting, which is how do we push the boundaries more? How do we make sure that we continue to open new markets? And so I gave the example of affordable housing previously. That was previously the remit of the not-for-profit sector. We created a for-profit venture so that we could build more affordable homes. But you also mentioned emerging markets. One of the challenges with emerging markets is that typically even the debt there can be sub-investment grade, which doesn't necessarily work for the UK regulatory regime. So we're looking at new innovative ways to tackle that market. We did we invested in an asset earlier on this year with Togo, which was wrapped by the African Development Bank. I'm really passionate about that sort of investment where we work with another partner organisation to provide really good financing where it is needed, but also working within the UK regulatory regime. And so if you take that then a bit closer to home, and you mentioned natural capital, I think that's where we can make a really big difference, because at the moment natural capital is something that we would love to invest in, but because it's a very nascent investment class, then it doesn't fit that well with highly predictable cash flows that we need to be able to back our liabilities. So this is where partnering with other organizations to be able to create more fixed cash flows, I think, is really important, so that we can unlock what is undoubtedly a really critical sector and something where we ought to very naturally play.
Yeah, that's really interesting. Is there any particular area of innovation at the moment that you're especially excited about, where you can see new development coming from?
So the emerging markets is definitely one. We'd like to do more examples like the investment we did with Togo. One of the things we've been looking at with partners and internally is whether we can look at some of the more predictable parts of natural capital and some of the less predictable parts and package them together. So, for example, forestry is one of those areas which there is already an investment universe, and so you can get an underpin of predictable cash flows. Could you partner that with, for example, regenerative agriculture, which is less predictable because it's a more nascent asset class, but can you parcel them together to create something that is looking like an investment grade set of cash flows? And so that is something that we'll be working on over the next 12 months, and really, really keen to see that come to fruition.
Is there ever a concern that if you're trying to sort of turn something from something it is into something it isn't, so if you're trying to make something more predictable than it is there a concern? Because we've seen this happen many times through the history of financial markets, and things kind of blow up. So are you concerned that you, trying to make illiquid assets viable via liquid wrappers? How do you prevent yourself from packaging something that isn't really ever going to be predictable? Where's the boundaries of limitations around that? How do you stop that from becoming a disaster?
Great question. So you've got to start with actually liking the underlying asset. So if you don't like the underlying asset at all, then you shouldn't be buying it, no matter how it's wrapped. So you should start with, okay, I want to invest in this asset. It's a really interesting asset class for me. And so the sorts of assets we're talking about are where either we really like the asset, but it's not very regulatory friendly. And so a good example of that is something like affordable housing. Got really, really predictable cash flows, but you need to be able to structure in such a way that it is less regulatory inefficient. And so that's easy. And then something like emerging markets, where you like the underlying, but actually you are worried a little bit about some of the tail risk, and so therefore you partner with an organization to take out some of the tail risk. Or if it is like my natural capital example, where you like the overall investment, but you would just like a little bit more certainty around the cash flows, and so therefore you parcel up something more certain with less certain. You still like the overall investment, but you find a way that it makes more sense on your balance sheet. So I think you're absolutely right. I think there's definitely been examples in the past where companies have invested in things that weren't really great assets to begin with, but were wrapped in such a way that they suddenly looked unbelievable, and in fact they were unbelievable. So our starting point in our investment committees is absolutely to begin with, do we like this investment? Do we think this is a good asset class for us to be investing in?
We've kind of alluded it to a bit in your answers to my questions, but could you talk to us a bit more about how an insurance company can be involved in investing in UK productive finance? Because obviously from the government's perspective, there's lots and lots of zeros flowing into insurance companies. It'd be nice to get a slice of that pie reinvested back in the economy, but we do have the fixed income regulatory constraints that we've touched on before. Does that mean that you're only ever going to invest in something with very predictable cash flows around infrastructure, toll roads, social housing? How do you see that developing? I mean, venture capital, for example, is always going to be off the table, isn't it?
Okay, so yes, you're right. We are predominantly fixed income investors, and so some of the asset classes you've just described are more natural than others, commercial real estate, infrastructure being really good examples. But even infrastructure, actually, it works much better if we have a good understanding of the pipeline. We can understand what the government is bringing forward so that we can start to put that into our plans, and the government has got a lot better at sharing some of those plans with us over the last 15 years. If I take another example, something we haven't talked about yet, so urban regeneration. So there's a big difference between local government and councils, and there are some who are incredibly progressive. Where you've got a very progressive local government or council, you can work together to think about something over a very long period of time. So take something like Cardiff. the plan that the local government had there to take it from what it was 15 years ago to what it is now via commercial real estate, via infrastructure, student accommodation, affordable housing, build to rent, they were incredibly progressive. And so, yes, each individual investment had to be suitable for us to bring onto our balance sheet, either via to back our pension risk transfer liabilities or for third parties. But working with the council, we could start to commit to that sort of money over a long period of time. The same is true with Oxford University, where we have a £4 billion partnership where we've joined our ambitions together to help create new labs, new accommodation for obviously a fantastic university. So I think that that is absolutely critical. You mentioned venture capital. So we have a small allocation to venture capital, less than 1% of our overall balance sheet. So you're absolutely right. Venture capital is not particularly efficient from a regulatory perspective. We like having it in our portfolio because it is an example of long-term equity. It's something where you need to be patient, and that patience is one of those virtues that insurance companies are good at. And so we do like having an allocation, but because it is very capital consumptive, it is something that we can't allocate large swathes of the balance sheet to. And so that is a challenge for us here in Europe versus, for example, in the US.
Okay, to sort of take a step away from investment, although I've loved that geeky investment conversation, and I really genuinely mean that. If we take a look, perhaps go a bit back up to the helicopter view, and we talk about the development of the insurance market. The other big thing that's happening in the UK occupational pensions is the move by DC away to building people's wealth, to helping them to spend it through retirement. We're seeing a lot of providers starting to take the first steps to developing those retirement income products, partially inspired by the government, who said that they want simplified choices and they want there to be a default retirement solution. Now, everybody you talk to in that space, when they talk about solving the conundrum of how you make sure that somebody has enough money for their entire lifespan, is how you manage their longevity risk. And a lot of people talk about drawdown to begin with and then switching into a deferred annuity. So everybody likes the idea of a deferred annuity, but that market hasn't really been developed yet in the UK. And that some have expressed some frustration that the insurance companies are so bound up in this huge buyout bonanza that they kind of lack the bandwidth to even start thinking about developing deferred annuities and annuities for that DC workplace market, which is going to be big and growing bigger. And obviously, we've got 41 billion a year flowing into auto enrolment schemes in the UK, so it's going to continue to grow for a long, long time. What are you doing about solving that issue? Is that a conversation you're having? Are you hearing people express that frustration to you as well?
I think it's a great commentary on the market and some really good questions. I mean, I see at least two big barriers to what you've just described, and the first is around talent. And so if we think about where have all of our best brains been focused over the last couple of decades. In insurance companies, there are fortunately some really good brains in the pension risk transfer market, and so contrary to your hypothesis, actually I think that's a really good place for some good brains to be, because I think that movement from pension schemes into insurance companies is a good move. I think where I might slightly challenge the talent allocation is around regulation, and so yes, we have made the UK and European insurance regulations much more stable and much more robust, but as a result some of our best brains have been focused on regulation and away from product innovation. And if you compare that to, for example, Asia, where you see a lot of product innovation, even in the US, then I think we are missing the opportunity to have some of our best brains focused on the sorts of products that you've just described. So let's imagine for a minute that we're all sitting in our labs creating these wonderful products, and we do have some people at Legal & General that are doing exactly that. We've then got to tackle the consumer challenge. And I don't know about you, but if I chat to the average 65-year-old, typically they are not worried about what's going to happen when they get to 85 and what happens if, unfortunately, they live too long. They're worried about either not living long enough, or they're worried about what they're going to be doing in retirement. And so I think there's a really important point here, which is that we do have an advice gap here in the UK market. And what we need, in addition to having the right talent focused on products and developing great products for consumers to buy, we also need to be working much more with consumers. And that's something we're being really thoughtful about when we think about the plethora of different options people need to be considering as they save through to retirement. And then, do they just retire age 65, everybody all at once, or do they actually retire a bit or carry on working for a bit longer? It's much more of a continuum, certainly, than when I entered the profession. And so this is something that people are going to need some help to understand the different options on.
I mean, certainly that when I've talked to people, and I've sat in a lot of discussions on this recently, is, the fundamental, if you ask people what they want absolutely the guaranteed income security of it that an annuity provides, but they also want to control their pot of capital and be able to hand it on to their relatives, which is, obviously we haven't managed to find a way of how to give guaranteed income without actually using that entire pot. And even in DB, you couldn't do that either. So that's kind of an interesting conversation that's got to be squared. And I know a lot of people are grappling with do you do it completely for them, i.e. do you just put them in a product that gives them a deferred income and then just switches them into a deferred annuity? Or do you ask them at a point in the future whether they want a deferred annuity, usually the point when maybe they're not as cognitively well as they were in the past? And I don't think anybody has any easy solutions to that right now. So I think we're going to have to see a bit of experimentation and see what comes out in the wash over coming years, or see if anybody can come up with a really good solution to that. It's definitely going to be an interesting one to watch.
I completely agree. And when you find the product where you can spend whatever you like, have a guarantee, and also give it all to your to the people who are inheriting your wealth, then I mean, every insurance company is going to want to hire you.
Yeah, and also, gravity probably doesn't work anymore in those circumstances in that universe, I would say. So this has been such a fascinating conversation. I could talk to you for another half an hour, but we keep a strict time limit here so that people can listen to the professional podcast on their commute. I have one final question for you. We've got a big fiscal event coming up in the form of the budget in just a few weeks' time. How are you feeling as a heavy investor in sovereign debt in the UK? And you mentioned that you now prefer sovereign debt to credit. How are you feeling about the upcoming budget and the direction you're seeing in UK bonds over the future?
So I did think I wasn't going to be able to escape this podcast without some mention to the budget. So we really like sovereigns. So it is slightly back to the future, because for much of my career, actually, sovereigns haven't offered sufficient value to be able to bring them into pricing. Whereas today, then we can bring them onto our balance sheet in a way that's both efficient and can offer value to our pension schemes and to our shareholders. So that's really important. There's been a big change in the supply-demand dynamic at the long end in particular. As pension schemes have got better funded, they're not buying as many long-dated gilts as they had previously, because they've already bought them, or they've bought out with insurance companies. So there are fewer buyers at that long end, and so therefore that has created an illiquidity premium at the long end, which is something that we enjoy trying to invest in. And then there is speculation about what's going on with the UK government that the market participants do take a view on. What I would say is that the credit default swaps on UK government bonds haven't changed very much at all over the last few years, and that is a good indicator of really how credit risky the investors really think the UK government is. And so I think we would bring that together to say that no one is really thinking that the UK government is going to default on its obligations, much as people like to speculate about it in the press. But there is definitely a liquidity difference versus, let's say, pre the Truss and Kwarteng budget in 2022. So I think we're in a definitely very interesting market. The markets have settled down a little bit in terms of where the spreads are between government bonds and other risk-free assets such as swaps. But we continue to like investing in sovereigns and believe that we will continue to do so post the budget.
I have one final question, which I always like to ask all the people I speak to in the insurance sector. Because we had Ashish Tefera from Aviva on the show a couple of series ago, Do tell me, so how big exactly is the budget sheet that you're responsible for, Gareth? I would like a few zeros to round off the podcast.
So I think you're asking about our total assets under management. So last
But
time we
not legal in
for
general,
my
but
team.
just a bit, yeah.
Yeah, so my team, the last number that we talked about publicly was £94 billion, and we've probably been adding to that since. So we're probably getting nearer to the magical £100 billion number.
Well, yeah, all you have to do is get a tenth of that 55 billion and you'll be there.
Easy as that. Thank you so much.
I think that's a great place for us to end the podcast. I just want to say thank you so much, Gareth, for your humour and insights. You've been a fantastic podcast guest. It's been great to have you on the show.
Thank you so much. Really, really enjoyed it, Charlotte.
And listeners, if you want to make sure you never miss a future episode of the Professional Investment Podcast, make sure you hit the subscribe button. Do interact with us. If you're listening on Spotify, take part in the poll. Do feel free to comment. And thanks so much for listening.